Enerplus is one of the companies with a relatively strong balance sheet. Now, its 2020 plan, announced in late January, was expected to generate free cash flow at oil prices of $50 or more per barrel. That's WTI. We're a long way lower than that now. We're joined by the CEO, Ian Dundas. Ian, thanks very much for coming on the show. I know it's a moving target, to put it mildly, but in late January, you said, I think I can produce free cash flow above $50 US WTI. We're down now, obviously, into the 30s. Where does that leave you now? Are you at risk of negative cash flow this year?
Oh, clearly. I mean, as you highlighted, our plans were predicated on higher oil prices. And so, we, like, I think every producer in North America, are re-examining those plans. As you highlighted, and I think it's important for people to know, I mean, we came into this with in a very strong financial position. And so, with our plans to generate free cash flow, we had lots of opportunities as to what we were going to do without paying down debt. Wasn't actually one of those. We didn't need to do that. So today we're re-examining it. Our goal is to stay financially strong and preserve that financial strength. One of the things that we've done as a business, and again, we've been living volatility for a while here. We really did create a pretty resilient business for us. Low debt was a part of that. Better cost structures were a part of that. We've got a very strong hedge book. And we also have very strong financial flexibility to really slow activity rapidly if the conditions require it. And it certainly feels like the conditions are requiring it right now.
Your target, you are basing your target on $2.25 US natural gas in America. Now, natural gas has had something of a turn up. But natural gas is also lower than that. I mean, how much pain would that cause you if natural gas prices stay weak?
Modest. We do a fair amount of natural gas production out of a project in Pennsylvania, but almost all of our capital and the vast majority of our cash flow are coming from oil projects. So okay. The gas moves, marginally helpful, but we're not a big gas producer.
And just remind us, where do you produce most of your hydrocarbons these days, Ian?
Yeah, the business has changed over the years. We're sort of headquartered in Calgary, but over the years we've transitioned our business almost entirely to the United States. And so the core of our company is a project, a high quality oil project in North Dakota. So we're a Bakken crude oil producer. I mean, that's where the lion's share of our capital goes. It's the key contributor to cash flows, and it's really where most of our activity goes up or down. That's what we're looking at right now.
Right. So obviously you don't want to, engage in schadenfreude, profit from the misery of others, but you must be on the lookout for assets if they come on the market at distressed prices.
Yeah, it's a good question. Today is today's a defensive day. Where we're making sure our activity levels are at the right levels to keep this balance sheet strong. Fast forward, our expectation is this doesn't rapidly change, although you never know what you're dealing with. So, are there going to be opportunities out there? Clearly, there will be opportunities. I mean, there were opportunities coming when the price of oil was $50. I mean, there's a lot of companies that got their balance sheets in a place that things weren't very exciting for them at $50 oil, let alone with what we're dealing with right now. So, I think, the industry continues to transition. I think this is just going to accelerate that transition. There's going to be fewer companies. Capital is going to be allocated to fewer companies who are managing it well, who are thinking about balance sheets and are thinking about the environment and ESG generals broadly. And so I think we are going to be really well positioned to move our way through this. And you don't want to take advantage of the misery of others, but it's a competitive business out there, and we've been managing capital pretty well.
It's interesting. I've heard a couple of analysts now saying that people want to see free cash flow. They don't want to see growth necessarily these days. Now, you did in late January announce slightly less aggressive 3-year liquids growth targets than you had in previous years. Was that part of this focusing? And apparently some investors were a little disenchanted with that. Is that part of your strategy, though, now scaling down the growth, at least in liquids?
Today, for sure. I mean, in a perfect world, you generate a lot of growth and you generate a lot of free cash flow, and life's grand. The reality is you've got to be able to generate what your business can provide, and the price of oil is a big part of that. So we looked at the market towards the end of last year, and we thought a more sustainable business, which was still providing pretty attractive growth, actually, was one with a little bit less growth and gave us more free cash flow. Today, that math doesn't work. Look, it just doesn't work. The profitability for the projects aren't there, and the cash flows aren't there. So, everybody is looking at what the appropriate capital plan is, and whether you're growing a little bit or not will be an outcome of that. As I said, we're in a really good place because we don't have to pay down debt, and we've got good operating margins. So we got a lot of choices around that, but absolutely, growth rates are coming down. There's nobody that's generating any meaningful free cash flow at these prices. If you look out into time, notwithstanding the price of oil has collapsed, a year out, the market's staying in the 40s, which is a very different world than $33 oil, which we're dealing with today.
I'm just looking, TD put out a so-called heat map of how bad it could get for the leveraged oil companies if the current strip continued as of yesterday. And I see they reckoned, even by the fourth quarter of 2021, you were at 3.4 times leverage, net debt to trailing 12-month cash flow. That's a lot better than a lot of guys out there. So it's interesting. They reckon for Q2, your debt only about 1.2 times. So really pretty low debt.
Yeah, I said we're in a good place, and we don't forecast our cash flows 2 years out, but I would tell you our plans are to be a lot stronger than 3 times. But as you highlight, on a relative base, as cash flows fall, cash flows have fallen. There's only so much you can do about that. You focus on costs and the like, but the starting point of your debt is a really critical thing. And I'm repeating myself here, but I think it bears repeating. Starting this place, starting from a position of financial strength, it's really been the hallmark of our business. And for the last year or so, on occasion you'd hear, are you under-levered, and what should you? I never felt we were really under-levered. I thought we were appropriately levered to deal with these kinds of things.
Just finally, and I know obviously it's early days, but do you think there's a risk that some of these energy infrastructure projects, Coastal GasLink, Trans Mountain expansion, Keystone XL, could they be jeopardized here by these low prices?
I guess anything's possible. I think most people, these investments are multi-year investments, long-term horizons, and as long as the proponents have the liquidity to go forward with them, and in one instance you're talking about the federal government, I would think those still go ahead. They weren't based on a view that we were going to be seeing $70, $80, $90 oil, and I don't think anyone thinks $30 oil is the new norm. It's just not the new norm. Even though we might be here for a year or two, it's a possibility. So I would think they still go ahead. I don't think this changes it very much. In fact, I think there's a possibility you're going to see governments talking about stimulus and those sorts of things to sort of help the economy broadly, and the energy subsector.
Right, and of course, the federal government announcing changes in employment insurance today as part of a package. Thank you so much, Ian. Thanks for joining us.
Yeah, thank you, Andrew.
Ian Dundas is the CEO of Enerplus.